Broke people who accidentally created billion-dollar businesses. This is how two broke designers accidentally humiliated a $570 billion industry. It is November 2008. Brian Chesky has $1,000 left in his bank account. His credit cards are maxed. His co-founder Joe Gebbia is one missed payment away from losing their San Francisco apartment. They have been rejected by every serious investor they have approached. The website they built is technically live, but barely anyone is using it. And the idea, the central, irreducible idea they are betting their entire lives on, is that a total stranger will pay money to sleep on an air mattress on your living room floor. That is not a metaphor. That is the literal product. And somewhere on the other side of the country, the executives running Marriott, Hilton, and Hyatt are not losing a single night of sleep over it. By 2020, Airbnb goes public on the NASDAQ. The IPO values the company at over $100 billion on its first day of trading. At that moment, Airbnb is worth more than Marriott, Hilton, and Hyatt combined. A company that owns 0 hotels, 0 properties, 0 real estate of any kind, is valued higher than the 3 largest hotel chains on the planet. The hotel industry had over a century of infrastructure, loyalty programs, global footprints, and institutional capital. Airbnb had 2 designers, a broken website, and an air mattress. Brian Chesky grew up in Niskayuna, New York. His parents were social workers. He was not born into wealth, did not inherit connections, and did not graduate from a business school. He studied industrial design at the Rhode Island School of Design, which is where he met Joe Gebbia. Industrial design is a discipline about solving real human problems through objects and systems. After graduation, Chesky moves to Los Angeles briefly, then follows Gebbia to San Francisco in the summer of 2007. He arrives with roughly $1,000 in savings and no job lined up. Gebbia is already there, scraping together rent on a loft apartment near Caltrain. Within weeks, the rent goes up. They cannot afford it. They need money immediately, and they need a plan. In October 2007, the Industrial Designers Society of America holds its annual conference in San Francisco. Every hotel in the city sells out. Gebbia emails Chesky with an idea: rent out space in their apartment to conference attendees. They buy 3 air mattresses, put up a basic website called Airbed and Breakfast, and list the space for $80 a night. 3 guests take them up on it: a 30-year-old woman from Boston, a 35-year-old father from Utah, and a 45-year-old man from India. All 3 guests are perfectly fine. Nobody is robbed. Nobody is harmed. The hosts make enough money to cover rent. This is not a business yet. This is 2 people problem-solving their way out of eviction. But embedded in that small, desperate transaction is something neither of them fully understands at the time: proof that strangers can trust each other enough to share a home. The conference ends. The guests leave. The money runs out again. Chesky and Gebbia bring in a 3rd co-founder, Nathan Blecherczyk, a Harvard-trained engineer, to rebuild the website properly. They apply to Y Combinator, the prestigious Silicon Valley accelerator run by Paul Graham. Graham later says that when he first saw the pitch, he thought the idea was crazy. They get in anyway. But the fundraising that follows is brutal. They approach 7 angel investors. 5 do not respond. 2 say no. One of the investors who passes is Ron Conway, considered one of the most connected angels in Silicon Valley. Another who passes is Floodgate's Mike Maples. These are not unsophisticated people. These are among the best early-stage investors in the world. And they all look at Airbnb and see something they cannot get comfortable with. It is the summer of 2008. Barack Obama and John McCain are running for president. Chesky and Gebbia are weeks away from running out of money entirely. They designed 2 novelty breakfast cereals: Obama O's, the cereal of change, and Captain McCain's, a maverick in every box. They buy generic cereal, repackage it in custom boxes, and sell them online for $40 a box. They sell 800 boxes of Obama O's and 500 boxes of Captain McCain's, generating roughly $30,000. That money keeps the company alive through the end of 2008. When Paul Graham hears about the cereal stunt, he does not laugh at it. He tells them they are cockroaches, meaning they cannot be killed. He says he finally believes they will not quit. The cereal stunt, an act of pure desperation, becomes the moment Airbnb earns its first serious institutional credibility. Not through a technological breakthrough, not through a killer growth metric, through breakfast cereal. Before we continue this story, let us know in the comments where you are watching from. We would love to hear from you. And if you are new here, click the subscribe button so you never miss any of our upcoming videos. In early 2009, Airbnb receives its first meaningful investment, $20,000 from Y Combinator. The growth is still painfully slow. Chesky analyzes the data and notices something. New York City has the most listings, but the conversion rate is terrible. People are browsing, but not booking. He flies to New York himself to find out why. What he finds is not a pricing problem. It is not a demand problem. The listings look bad. The photographs are dark, blurry, taken on old phone cameras from unflattering angles. The apartments look nothing like places a rational person would pay to stay. So Chesky and Jebbia rent a camera and spend a weekend personally photographing listings in New York. They go apartment to apartment. They shoot the spaces properly, wide angles, natural light, clean composition. Within 1 week of those new photos going live, New York bookings double. Between 2008 and 2012, as Airbnb quietly compounds its growth, the major hotel chains are not sitting still. Marriott is expanding its portfolio. Hilton is executing a $26 billion leveraged buyout under Blackstone, one of the largest private equity deals in hospitality history. Intercontinental is rolling out new loyalty tiers. The industry strategy is vertical integration. Own more properties, build more loyalty points, lock in more corporate accounts. Nobody inside these boardrooms is modeling a scenario in which millions of private homeowners become their direct competitors. The conventional wisdom is clear. Consumers want consistency. They want a bed that looks the same in Dallas as it does in Dubai. They want a predictable experience. And for decades, that conventional wisdom was correct. By 2014, Airbnb has 4 million listings in 190 countries. The hotel industry finally responds. What follows is one of the most aggressive corporate lobbying campaigns in modern American business history. The American Hotel and Lodging Association begins funding research studies, commissioning reports, and working with city governments to frame Airbnb as a housing crisis accelerant. New York City passes Local Law 257, restricting short-term rentals. Barcelona limits new licenses. Berlin bans entire apartment rentals without permits. Marriott's global revenue in 2014 is roughly $13.8 billion. Airbnb's estimated booking value in the same year is around $7 billion and climbing at a rate no traditional hospitality company can match organically. December 10, 2020. Airbnb lists on the NASDAQ under the ticker ABNB. The IPO is priced at $68 per share. By the end of the first day of trading, shares close at $144.71, a 112% increase from the offering price. The company's market capitalization at close, approximately $86.5 billion. The full diluted valuation pushes past $100 billion. Marriott's market cap on that same day is roughly $38 billion. Hilton's is approximately $28 billion. The two largest hotel chains in the world are worth, combined, less than 2/3 of a company that owns no hotels. Chesky, Jebbia, and Blecherczyk, the three men who kept the company alive with novelty cereal boxes, are now each worth several billion dollars. The hotel industry did not lose because Airbnb outspent them, outlobbied them, or out-innovated them on amenity features. They lost because they optimized for the wrong signal. For a century, the measure of hospitality was consistency, the guarantee that experience would be predictable, controlled, and branded. Airbnb did not compete on consistency. It competed on belonging. It offered something hotels structurally cannot offer: the feeling of living like a local, in a real home, in a real neighborhood, inside someone else's actual life. The hotel industry optimized for comfort. Airbnb optimized for connection. And that difference, invisible on any balance sheet in 2008, turned out to be worth $100 billion. What is your take on this? Comment below. I am reading every single one. If this story resonated with you, hit the like button and send it to someone who needs to hear it. And if you want more stories like this, check out the previous videos on the channel.